Hi, and welcome back again to Tim Bigham's Options and Volatility Newsletter. We'll be taking a look at the vol reversion on Sable Offshore SOC, where some huge repeat call buying, as we talked about a couple weeks ago, set up ideally for a multitude of trades. We'll take a look at how those fared as expiration approached. So let's jump in and take a look. First of all, here's that implied volatility, that huge spike that we saw that set up all the different trade ideas. We'll take a look at which ones in a second. You can see that vol reverted sharply, right? Even came in a little bit yesterday. Here it is. Here's the day basically of the trade idea. You can see vol did revert, not back to where it was. We never wait for that, but certainly a very nice vol reversion, enough, as we'll see in a second, to have some very nice profits. So taking a look at that September buy right that we had recommended, which was just going out, buying the stock, selling these very expensive September 25 calls. And you can certainly take a look at the previous video. All these trades are described in detail here, but you can see that that buy right had dropped to basically 2067 because IV exploded here, right? We saw the stock actually going down, the calls going up in price, set up ideally for that covered call trade. Buy the stock at 22.80, sell these calls a little bit over $2, right? And I took these prices off from right after the opening on Friday. Stock had actually gained 79 cents, now at 23.59. The calls dropped to basically 30 cents. They ended up expiring worthless, and the stock closed around here, but certainly you don't want to hang on till the bitter end, right? So an overall gain of $2.60, or well over 15% on that trade, all for the stock basically going nowhere. It crept up a little bit, right? But we made twice as much on the short call as we did on the stock. Going out to November, same sort of idea there on that November buy right. As we can see, IV jumped to 121. Those calls went to $2 because of all that big call buying. You can see the stock actually went up in price. The calls dropped sharply in price. So because that IV dropped 20 vol points, right? Stock up 76 cents. These out of the money November 35 calls, a fairly low delta option, right? Gained 80 cents because of the IV reversion from basically 120 to 100. So the overall gain on the trade, $1.56. So again, basically doubling your gain with the calls matching the stock gain. So the stock went up, the calls came down. The reverse of the original trade, where we took advantage of the stock going down and the calls going up. So that is an absolute reversion in a nutshell there. The Iron Condor basically went out worthless as we looked at that. Previously, it had jumped to $1.02 because IV exploded on the Septembers. We saw this massive repeat call buying. These were well out of the money, right? 5 points out of the money on either side, with roughly just 2 weeks to go. That Iron Condor, in essence, expired worthless, so you got to keep the buck that you sold it for, close it out for a nominal price of a nickel or so. The bull put spread absolutely expired worthless, right? Able to sell it, right, at basically 80 cents because of this huge explosion in IV. So if you wanted to follow the call buying more closely, that would be a bullish position, right? It was trading at 60 cents, so you got a huge pop here. So with the stock going up, the put spread actually went up in price. That spread expired worthless. We were able to keep on to that. And then the NOV 22.5, kind of at the money straddle back then, jumped, right, with the stock dropping 28 cents, right, more towards the 22.5 strike price, right, back on the day September 6th when we had the trade idea generation hit, right. The straddle actually went up $1.25 because of that huge jump in IV of 56 vol points, right? Able to sell it at just under $6. Theta, as we had mentioned too, increases huge when you have this IV lift. So theta jumped, or time decay, to 23 cents. You can see that straddle even with it getting away a little bit, right? The stock went up in price, so the straddle should have probably gone up in price. Time decay maybe go offset there, right? But you can see that straddle now $1.63. Why? Because of the huge time passage, that time decay. So back here, your break even, right? By selling this at 6 would have been $28.50 and $16.50. The stock really never went anywhere near there. So taking a look at kind of the IV reversion again, here it is here. Here it is here, and that's the big reason we jumped in and took advantage of this massive spike in IV and SOC simply based on huge repeat call buying. So hopefully provide some insight how we go about identifying trades, positioning, right? You can position for a straight vol capture. You can lean bullishly with that call buyer with the buy right or selling the money put spread, or do an iron condor or a sell straddle to capture the vol. So until next time, as always, here's the good trade.